Everybody, and thanks for joining on this call. Welcome to the call. We have industry veteran Mr. S. Naren with us, and we have Bharat Parekh. So before we hand it over the mantle to Naren to tell us in terms of how to decipher what is happening in the budget and how do we see it impacting India, let me first introduce the panelists to you. So we have Mr. Bharat Parekh. Bharat, if you can just raise your hand so people can see you. Thanks. So Bharat is basically head of our products. He was working with Prashant Jain and HDFC AMC for a period of 12 years. Before and after that, he moved to Reliance and he was managing the treasury, which was 75,000 crore treasury of one of the richest person in the country. Obviously, you all can understand whom I'm referring to. After that, he joined us as head of products and he'll be anchor for the event today. Now I come to our eminent speaker, Mr. S. Naren, who doesn't need much introduction. He manages one of the biggest AMCs and he is the turnaround man for the country, a man with the Midas touch. That's what people say. You can rely on him. So just to introduce and tell you about things which are not in public domain, he is from IIT Chennai and he's also from Amrit Kaal. Right? He manages one of the biggest basically AMCs for the country. And he has been consistently there with over 2 decades of experience. One of the most consistent fund manager, globally recognized for a lot of his. And if I can talk about his laurels, then it will take another half an hour. So with the time in hand, I'll move it to Bharat to take it forward from here. Once again, welcome everybody. Bharat, over to you.
Thank you, Manish, and welcome, Naren. So it's, just to start with, Naren, what all said is that this is a realistic budget, a budget where we have most of the numbers which we can correlate and say, yes, they are achievable, they are doable, they are possible. A capital investment focus budget where that entire capex or a capital expenditure has been raised to 3.5% of GDP with 10 lakh crore of this one. Last year, they were not able to spend that money, but this year again, they said that, yes, we will make an attempt to do that. On those particular line in terms of the theme of this budget, if you can just share your thought, Naren, how do you see this budget and how this is going to make a difference to us?
Yeah, I think we have to see the evolution of the budgets, and what you can clearly see is that we are used to thinking of budgets of the 90s. Budgets of the 90s were very important because at that point of time, it was moving from pre-reform to post-reform. So the budgets were very important. That period is over. And then we have GST Act, which means that a lot of things that could be done in the budget has moved out of the budget and just moved to the GST Council. So what can be expected out of the budget itself is much, much smaller today and cannot be compared to what it was in 90s. I think over the last decade, what the government has done successfully, if you ask me, is that they have managed to remove all the cobwebs in the entire income tax area and made it a much more computerized environment and slowly removed all the concessions which are there for the taxpayer. And actually, they have done it in such a way that, people have no choice but to pay tax. And in a very big way through computerization that they have managed to do. And through all the revenues that has been collected, both on the direct tax on the individual side and the corporate tax side, they are using it to do capital expenditure. Particularly, first we did it in roads. Now they are trying to do it in railways and any other area where they can do to improve infrastructure. And that is what the government has been successfully doing at this point of time. So if you look at it, the budget numbers not only this year, but even in the last 2 years has been very, very correctly calculated that even in the last 2 years, right till the last month, people felt that the revenue was under budgeted, not over budgeted. And that is the situation which has happened. And for the last 2 years, normally, By the time 5 months is over, people will say fiscal deficit, your target for the target is achieved. But for the last 2 years, that has not been the case. So because revenues have been properly budgeted in the last 2 years, so again, I think revenues have been properly budgeted. So we are in a good shape on the fiscal side, much more due to the tax administration part of it rather than taxation rates. Because the extent of computerization has happened to such an extent that tax administration has improved significantly. And that played a much bigger role than anything else at this point of time. And that's how we see it at this point of time. But at the same time, I don't think there is any scope in any budget to have dream budgets like 90s or something like that, because all the dreams have already kind of happened. That people won't know that there used to be very, very high short-term capital gains tax, very, very high long-term capital gains tax. All those things have happened. That this year, if you ask me, reducing the highest tax slab was itself a dream, because that was all that was possible, and an increase in the tax limit at the bottom was again something which was like a dream. That's all is possible at this point of time.
So Naren, as you rightly mentioned, that they have projected quite reasonable in terms of what can be potentially the revenue and ultimately the expenditure. The fact is that they are talking about a GDP growth number of 10.5%. The revenue growth number is also broadly in the similar 10.5% kind of a number. And they've also tweaked both the end, right? For an ultra HNI, they've reduced the the surcharge to 25%, effectively bringing down that tax rate. At the same time, at the bottom of it, for the guys earning up to 15 lakhs, they've also tried to reduce the tax implication. Now, if you look at both these sides, they have tried to give more money in the hand of consumer. On the other side, we see that the growth numbers, even the nominal growth numbers have been, projected to be much lower. How do you see this combination of an effort to give higher money in the hand of the consumer, at the same time the expectation that consumption and the growth will be much slower? How do you see this impacting the sector, specifically the consumption part of the story and the rural economy?
I don't think the goal is to grow consumption slower. I don't think that is the goal of the government in any way, or to grow slower. I think the goal is to grow faster, and clearly the goal was to put some more money in the hands of the middle classes, which is what they have done. What the people will do with the money that they have extra is not under the control of the government, and that will depend on what individuals do, and that you cannot predict. So I don't think we are in a situation where there is something that can be correctly predicted as to what the people will do based on how they see the situation. That is what it appears at this point of time. But we are not really concerned at this point of time on whether consumption will grow to the very big extent or not with the extra money. But having said that, if you look at how the different companies have shown results, we have seen that many of the FMCG companies which cater to the bulk majority of consumers in this country, those companies have not been delivering good numbers. So we are hoping that if more money is given to this entire audience, maybe there will be an improvement in that area. And we are hoping on that area, but we are not sure what will happen, because finally we are a free country where people will do what they want with the extra money. And that is how we see things, and that is how the situation looks at this point of time.
The point which I was trying to make is that, see, on one side, they're trying to give extra money in the hand of consumer, and hopefully, that will spur more demand and ultimately growth. At the same time, the expectation of growth numbers are much muted, right? At 10.5% compared to this one, we can always say, okay, the inflation is going to be lower and hence. But if you have a lower nominal GDP growth, there will be impact of that on some industries and some companies in their top lines and the bottom lines. And will that also change dynamic in terms of your expectation in terms of growth or degrowth in terms of the earnings? Because ultimately we are trying to see what will be the impact of those in the earnings.
Yeah, that part of it is true. This whole, what happens is, for the last 2 years, we had very huge wholesale price index movement. That huge wholesale price index movement resulted in a situation where that benefit came to the entire GST collections and various tax collections. I think the next year wholesale price index will be very low. And because wholesale price index will be very low, it will be tough for GST and other collections to actually zoom. And that is precisely what you're saying, that the outlook for earnings is okay, but it is not going to be supported by huge GDP growth on the nominal side. See, we always think of GDP growth on the nominal side, which includes an inflation component. But I don't think there is a problem of GDP growth on the regular side. It is because inflation is going to be lower on the wholesale price index side that the nominal GDP growth is going to be lower. And that is how we see it at this point of time, actually.
So, in that context, is there any particular sector in terms of the capex or in terms of this where you believe there can be potentially some changes in terms of earning estimates or changes in the earning estimate because of the budget?
See, the budget, I would say, is pro capex, and there is absolutely no clear that it is a pro capex budget. The question always, the way the markets reacted, let's say yesterday or even today, is nothing to do with the budget. See, what happens from a stock market angle is there is something called implied market assumptions and what is there. And sometimes implied market assumptions can be higher than what is there in the share price. So people always think that you have to see an upward reaction. But if the implied market assumptions are too high, that can be a source of problem. And that is what we see, which we have seen over the last 3 to 4 months in India, that it is not a problem of India. It is a problem that the implied market assumptions of the market has been much higher. And that is the challenge at this point of time for the market also, that the implied market assumptions are high rather than a problem with the market per se. And that is how we see things. So I don't think there is any per se problem at this point of time in India, but the implied market assumptions which are already there in the market is much higher in India than it was, let's say, in China over the last 3 to 4 months. China was priced for something to go completely wrong. Some of the US markets were also priced for something to go completely wrong. So when people realized that maybe US won't go through a deep recession, the markets had to take off. It had nothing to do with Indian market be good or bad. Sometimes everything is relative in this world, and that is what we have seen over a period of time.
So Naren, the point you are making is that ultimately the momentum or the sentiment of the market is much beyond what's really happening in the budget and the numbers, because we are also an integrated player, and this will come together. And in that context, Naren, there's one question from one of the audience is, what's really happening in the market for last 2-3 days, and what's really happening because of a particular group and all. And the question from the audience is that, we have seen this kind of episode happening, whether it was 2018, again, then what really happened into the media group and now to this conglomerate. So is there anything which we need to think about? How do we really look at, and, how mutual fund, the industry as such, and the professional and investment managers have been, tackling this particular part of the story?
See, the way, having spent more than 18 years in ICICI mutual fund, see, the lessons that we have learned are actually very simple, actually. If the markets are very cheap, what you have to do is you have to bet on the market, and you have to bet on those cheap sectors. You have to bet on those cheap stocks. and suddenly there'll be a trigger, and those triggers will result in that stock or sector going up significantly. And for example, in 2007, infrastructure became very overvalued. We didn't know what will be the trigger which will make the market become cheaper, but it did become cheaper at some point of time. The global financial crisis turned out to be the trigger, which resulted in infrastructure actually underperforming at some point of time. So similarly, when something is overvalued, you'll find that something happens and then the market becomes cheaper. Like, for example, India was overvalued relative to the world. And we always used to think, how will it become cheaper? Because after all, India is a fantastic structural growth story for the next 2 decades. So how will it correct? How will it correct? How will it underperform? How will it underperform? So finally, what happened was, what has happened over the last week is that there were some reasons which happened, and then the market has now used that as a reason to underperform the market. And so what happens is that, so when the markets are overvalued, they'll find a reason at some point of time for the market to become cheaper. When the markets are very cheap, you'll find a reason for the market to become costlier. And you won't be able to predict what is the trigger. And you can spend a lot of time trying to think of trigger. You won't be able to predict it. It is important that you buy when it is cheap and you sell when it is costly. And that is what you can actually predict actually. And for that, you need to take pain, because what happened is that, let's say in 2007, when infra was costly, you couldn't have predicted when that infra will become cheap. Or in 2008, when everything became cheap after Lemon, you couldn't have predicted what will take the market up after that. So this happens. It is just that you have to be patient. And so our view is that, you have to, at various points of time, decide to be systematic, and you have to be willing to take pain and follow an asset allocation framework. You're sure to make money with that framework. And that is how we see it. And it is impossible for you to predict the triggers. We have been continuously saying on TV and every channel that Indian market is not cheap, it is costly. So follow an asset allocation framework, because Indian markets are not cheap. But there will be a time when we'll realize maybe instead of just putting money only in asset allocation, you have to put money in equity, because equity has become very cheap, and that can happen at any point of time. And this is the learning that we have, that in 2020, for example, markets had become very cheap, and you have to put money in equity aggressively, and that kind of a situation can again occur at this point of time.
So, Naren, to sum up, what will make you believe that we are cheap enough for us to do a large equity allocation? We have seen, not a correction the way we have seen in some of the Asian peers of China, or almost 35-40% correction in the Nasdaq. But in India, the correction has been limited. We are close to 10% or not even 10%, less than 10% down. Is there any particular sectors or particular pocket of the market which you believe provide you that kind of a value orientation for investing? Or is there what level of Nifty you believe that potentially there can be a good risk reward in terms of being in equity than current?
See, we use something called as an equity valuation index for our fact sheet, and that equity valuation index we show in different colors. And that index, effectively, today my colleague who actually publishes it every month in the fact sheet was saying that on a 5% fall from here, the fact sheet will start looking green. So which means that on a 5% fall from here, the market will look cheap. That is what he was telling me based on that whatever I could make out from that. That is the kind of situation that was there. And so on a 5% correction, it looks like in large cap markets will look attractive enough to make that investment. This is what it looks. See, this does not mean that the market will go down 5%. And this should not be attributed to a statement that the market will go down 5%. Markets can stay much, much higher than what we want it to stay, and market can overshoot significantly also on the downside. So we have this perception that fund managers can have any view they want on any stock or on the market, but the market will have its own view, and it can, if you want it to fall 5%, it can fall 15%. And if you want it to fall 5%, it can choose not to fall at all. And that is how the market operates. And that is how we look at it from a different lens. And that is the framework that we believe in.
Yeah. So Naren, basically you're saying that maybe if we have a 5% kind of a fall, if we have, it may become more on a risk reward basis. It will improve the odds for us to be, little bit more aggressive in equity compared to where we are today. And on a similar line, Naren, we have a question from one of our audience. He's saying that Nasdaq 100 index is down almost 35 to 40% as compared to the last year. And the companies are very good and definitely bounce back in a couple of years. What's your view in terms of global allocation and US and China allocation?
So our view has been that you should systematically invest into global funds like our Global Advantage Fund at this point of time, given that America or China have underperformed significantly the Indian market over the last 1 year. And the best time, of course, was last 4 months back. And that was about the best time to invest internationally. But we continue to think it makes sense to systematically invest into international funds, even today, starting today. And that is my preferred way of investing at this point of time, given that global markets have become very, very cheap compared to Indian markets.
Great. Naren, maybe from the asset allocation point of view, we spoke about equity, we spoke about international. And the fact is that, fiscal prudence been maintained in the budget from 6.4 to 5.9, and she committed of 4.5 in 2026. At the same time, if you see whether it is their estimate in terms of the disinvestment, in terms of their the dividend from, whether it is from RBI or the PSUs, all looks reasonable and in line with what they've really realized in last year or so. Is there any thought about the monetary policies where we are today and the debt part of the portfolio?
Debt has become a structural asset class for any person, actually. And I believe that most audiences at this point of time do not have enough investment in debt mutual funds. And our belief has been that there is a need to create a very big investment in debt mutual funds. Some of them have it in the form of bank deposits and various other ways, but I think debt mutual fund is just absolutely attractive for investment at this point of time. The combination of the fact that, you have instant liquidity, a very, very stable tax regime for debt mutual funds, means that there is no better way to invest at this point of time than invest in debt. And debt is somewhat like a everyday product, like Walmart says, everyday low price. This is an everyday lump sum product for any investor at this point of time.
So will you, are you recommending long in terms of duration, or what's your take maybe over a year or two? What's your take? Is the client should go and be in the defensive mode of that, maybe 2 to 5 year or 2 to 4 year kind of a segment, or you believe the long end of the curve also provide lot of opportunity in light of the fact that, we are very close to the peak of interest rate in India, and also Fed has yesterday in the FOMC indicated that maybe a couple of more rate hikes, but broadly they are also done. So in that contrary, are you or your framework suggesting a duration call or more of a deployment call?
See, our view is that, we believe that short duration debt is also equally attractive at this point of time, because short duration is giving you same returns as long duration at this point of time. So why take the risk of long duration is one way of looking at it at this point of time. But most important is invest in debt. People always think we are in 2021 and early phase of 2022 when debt was giving very, very low returns. Today, you are getting much, much higher returns as yield to maturity in all the debt products. So our view at this point of time is it is necessary to invest in debt. And as ICICI mutual fund, when we go and tell people that most people have investments, very little investment in debt, they all have investment only in equity or hybrid. They don't have investment in debt, and it is such a tough task for me to convince people that they should have investment in debt mutual funds. And I believe this is the time to start it at this point of time.
Okay, great. So Naren, broadly we understand your thought process in terms of the asset allocation and this. Now, if somebody is looking for a particular theme or a particular sector in light of whether it is in terms of the economical cycle or whether it is in terms of where we are post the budget, including the capex and railway, is there any particular theme or any particular asset class or any particular sector in the equity which you believe can potentially provide a superior return over obviously 2 to 3 year time horizon, not asking for a very short view, but is there anything which you believe can?
So the themes we have been investing, one is pharma in a big way, actually. And, we have rarely invested in, for example, in FMCG, but ahead of, we have been a bit more positive on FMCG funds, although in the recent past, simply because of the fact. So, we have a fund called Thematic Advantage Fund of Fund and a passive strategy fund. Both these funds, if you look at where we are invested there, gives you a good idea of where we are positive on. We've been reasonably positive on banks, but the over ownership of banks, I think, played a role in ensuring that the banks did not deliver returns in the recent past. So these are some of the areas that are there. We are not very big proponents at this point of time of small and mid cap. And those are the areas where we retain some amount of caution. And we continue to think asset allocation or multi-asset is the way to go, given that we are still in a phase where market volatility will be high and that multi-asset actually is likely to give investors a very good experience. And we have also been recommending technology recently, particularly for systematic investing. But we've been very surprised that it actually gave very good short-term returns. What we had thought of is that you invest in the whole of 2022, it will be a good period to invest for the long term. But it has started to give returns right at the start of the year.
Naren, you actually, one of our client wanted to talk about IT, but you have covered this. So you continue to be bullish on IT. Now, what's really happened in terms of their export, and now considering that if world is going to be slower, including us, do you still positive on IT, or you still believe that they will deliver the desired result?
My favorite way of investing in technology or export is to do a 12-month SIP so that it covers for possible risk of a big slowdown in US in this year. Who knows, there may be a recession, let's say in the third quarter or something like that. And we are well positioned by investing in IT over the year. And that is, I think, the biggest advantage would be to do systematic investment into IT or export fund, so that in case there's a global recession, you're actually investing into that recession.
Naren, one more related question again from your asset class point of view is about the gold and silver. What's your now considering what's really happening? The Fed rate is closer to the peakish, and all the fact that markets are looking at gold and silver as an alternative. What's your take on gold and silver, and what percentage of portfolio allocation should be there as a part of gold and silver?
Silver, we started looking at silver in October, and it has been slightly frustrating because the returns came too front-ended. Again, there has been an increase in customs duty yesterday, and that has added to the return in silver. It's been one of our most frustrating calls because we thought that the return will come slowly, and the return has come just too fast. So we're just grappling with this issue in gold and silver that finally today, instead of recommending, both the calls for us work very, very well. But because it worked very, very well, we have moved to a situation where we are recommending now only multi-asset because we don't want to put too much money in gold and silver, simply because of the fact that we have got returns too easily. And whenever we get returns too fast and too easily, we have our own doubts. And that's why we are recommending now only through the multi-asset route and not standalone route. Although we are very positive on gold and silver, we are too scared after the big outperformance in the recent past.
So you're saying that anything in form of your structural allocation, it's okay, but technically you should do it through a multi-asset fund rather than trying to do a independent additional
Exactly.
gold and silver.
Exactly.
Okay.
Exactly.
Okay. Understood. If anybody have any more questions, we are more than happy to take questions. The idea was that, you guys might have heard about a lot of stuff on the budget, but here, we are trying to spend more time about portfolio construction and how really this budget will help us in terms of this. Naren, there is a specific call about, you already mentioned that you are not very bullish on the small cap and a mid cap space. But now considering that the India growth story is much superior, and at the same time, there are a lot of, bottom-up stories available. Do you see there's anything in terms of any of the strategy where you can really take advantage of the fact that it's going to be a 5 trillion economy and the growth will be much more widespread? Is there any story there in the small cap? May not be from the index point of view because relatively you don't find it to be attractive, but from the bottom-up story because those stories will be much more in that part of the world rather than the large cap.
Tough because all the funds have outperformed the index too much. So which means that the funds have some stocks which are pretty costly. And that is one of the reasons why I'm a bit more worried because the small cap index has done very badly. And the mid cap index has done also only just okay, whereas the funds have done very well. And that's why I find it difficult. But I think the idea that you mentioned that if you're able to get the right kind of persons to be involved in any of these products, then one can look at it.
Any in your multi-asset or your assets, how are you placed in terms of the small cap and mid cap? Are you allocating there?
No. We are cutting our allocation because when we look at individual small and mid cap stocks, many of them turn out to be extremely costly at this point of time. So people do say stock picking, but many of the stock picking is done in very high valuation, this thing. And unlike large caps where there has been periodic very, very high redemptions, including in the last 3 days, there has hardly been any redemption in this. So consequently, what happens is that I'm worried that many of these stocks are very costly. And that is the reason why I've been very cautious in this segment.
I'm not sure, Naren, but is it a relevant question? There are a lot of questions about the MLDs, the changes in the MLDs in the budget and the changes in the insurance. How do you see these two?
So I expect that in insurance, at least people will invest smaller amounts because that is what they would do. Why invest more than 5 lakhs? That's what I think people will do. And on MLDs, I'm not an expert. And I think it can't happen that, if you're investing in an FD in a bank or a mutual fund, the interest rates are taxed in a particular way. And in another way, you get debt interest, and that debt interest is taxed at 10%. So then that was not something which was okay for the government, that people are getting such low taxation on debt investment for a year. So that's why this happened, I guess. But I am not an expert on both. So that is the reality.
I am not sure, Naren, but is it a relevant question? There are a lot of questions about the MLDs, the changes in the MLDs in the budget and the changes in the insurance. How do you see these two? No, because the question is coming from the context, Naren, is that one that we have seen sharp downtick in, these, insurance company stock prices. And, market has reacted quite aggressively in terms of the reaction. So is it going to be materially different, not only for the industry, but also from the asset allocation point of view?
I think, no, normally sometimes the market actually over exaggerates some of these problems, and coupled with the fact that people will move to the new taxation regime, and in the new taxation regime, no one will take any ATC. That is the other thing that people are thinking about, and that's why it has become a bit more complicated.
Any take on chemical sector? There's one of a client who wanted to specifically check about chemical sector.
We have been cautious on this sector and miss the uptick, so we are enjoying the fact that we're not getting irritated with the uptick.
Okay. Naren, I don't know to what extent you will be able to answer this question, but I'll try my luck. So one of our client is asking that recent allegation on one of the group, if by any chance it will extend to other linked sectors like bank, will not change all the dynamics of the Indian stock market? Will the whole story around India not solicit being revisited?
I can't answer that question.
But any linkages with the bank and that implication on the banking sector?
I'm saying no, people always don't realize that equity risk is different from debt risk. So if a company has a lakh of crore market cap first, why do you have to worry about debt first? That is my question always. You first worry about equity, not about debt. Always equity is a higher risk asset than debt. That's all I can say. Otherwise, I'm not in a position to say anything.
No problem. I understand that. Anything on power sector and utility, Naren? I think you've been very
positive on the sector. We have been very positive on the sector. We continue to be very positive on the sector.
Both power and utilities?
Yes.
Okay. So basically, and on banking, you are banking you were more neutral, right? Or you are still there?
No. In banking also, we have been positive after this correction. We are reasonably positive on the sector, on all the companies which have a good banking, which have a good current account and savings account franchise. We have been positive, actually.
So, Bharat, I have a few questions on my panel as well.
Yes, Manish, go on.
So, Bharat, this is a macro question. You had seen Nirmala Sitharaman talking about Saptarishi. So, how does HNI and Ultra HNI look at that, and what is in it for them? How do they take advantage of that?
I didn't understand that Saptarishi. I don't know.
So, Nirmala, Bharat, if you can just dwell on that.
Saptarishi, I didn't understand this, Bharat. What do you mean by that?
Naren, I think the theme
Bharat,
of the budget. So this was a theme of the budget where she started with those 7 points, and how really she is trying to address each of those, and whether it was work and all. So it was the theme of the budget, which was what Manish is talking about.
I don't have much to say, actually.
So, Bharat,
Manish, I think it was more of a theme. I don't think there's anything much we can do.
Okay. The second question is in terms of US economy and China economy, versus pre and post budget, how do you see any difference there to India? Obviously, from India perspective.
I think China was in lockdown for 3 years. From there, they have moved to a non-lockdown phase. So all the accumulated savings will be used for consumption. So people believe that there will be an opening up trade in China. And that is what people believe in. US people now believe in a soft landing. So which is the reason why the markets are in good shape at this point of time.
Okay. The other question was pertaining to India's GDP growth, which is other part of the world. Pre and post this budget, how do you think we are in better position versus previous time? What is something which will impact us, and how will we grow further from here?
Can you just repeat the question?
So pre and post budget, how will the India's GDP growth will get impacted? What is something which will help us in terms of accelerating the growth?
So this is what we have to now recognize, that the budget cannot change things drastically, because the budget is no longer something which can completely change things, because all you are doing is fiddling with a few things in income tax. That's all the budget is. Then there are certain things where the money can be used, like this time they are doing it in capex. That's all. Beyond that, this budget cannot drastically change things. That is the reality of what we have to get used to, the fact that the budget cannot completely change things.
Okay. The other question is asset allocation, which you and Bharat both can handle. So they are saying, basically people were saying, what is the allocation which you should increase now for long term on equity side and on debt side? So if you were looking at 50-50 mix previously, post budget, if I'm looking at 3 years, what is the allocation which will increase on debt side?
See, my view is that slowly, as the markets have been underperforming the world and correcting, I think slowly you have to increase your equity allocation. And in debt, my view is that there is a case at this point of time to invest in debt, or incremental savings. Investing in debt, the opportunity has been there and it should be done. That's how I look at it. Bharat, you can add.
Yeah, I think definitely. I think a lot of clients who had been staying on the sidelines and not taking advantage of the debt because of the low interest rate, as Naren mentioned, maybe a year back, there was interest rate was so low that there was no reason to really look at debt as an investment opportunity, and they've been moving that money to cash. Just to give you the number, I think at an industry level, Naren, you can correct me. I think 1,60,000 crore non-corporate money is actually lying in the liquid and ultra short-term funds. So there is a big chunk of money which is still lying in cash from the individuals. And I think part of that money either start moving to equity, as Naren mentioned, as this market has been underperforming, as we get closer, and if we get those 4-5% kind of a correction, I think there is a reasonable opportunity to really increase the equity allocation. At the same time, if the cash allocation can be moved to debt, and there's no need to be bearish about and having a very large cash structural holding.
Sure. So now another question on real estate, your view on that, given that from last 7-8 years it has been stagnant and the growth has been muted. Do you see any trigger point which will increase the growth here?
I think the real estate market post 2020 has been in much better shape. Transaction volumes have gone up. The leveraged real estate companies, many of them have managed to sell their surplus real estate. So things are in good shape right now. I don't think real estate sector is in bad shape like it was in the pre-2020 phase. Post-2020, things have been in good shape, and there is no specific problem I see in the real estate sector at this point of time across the country.
Sure. Mohit, you may have some questions in your panel. Can you ask few questions if you want to ask otherwise also?
Yeah, a couple of clients had asked me this question that, they have been investing into, equities, debt, and as well as asset allocator funds, dynamic asset allocator funds and the balance advantage fund. With a moderate risk profile, what I normally see of the clients, what we have, they say that, and ask me sometimes, regularly ask me a question that why should I go towards equity investment? Why shouldn't I apparently put all my investments across these asset allocator funds, dynamic, advantage funds, hybrid funds? I thought I'll take your view, because they automatically move between debt and equity.
I've never got this question before. Most of the time, people come and tell me I'm too cautious. I keep recommending these funds. So I've been asked this reverse question today after a long time. So I'm very happy to answer this question. My belief is, at various points of time, there is a case to invest in pure equity. Go back 4 months back, look at investing in China, Japan, Korea, Taiwan, US. The kind of return you would have made by investing for 4 months back in these countries would have been stupendous. Go back to 2020, April, May, June, July, August, for example. put money in equity, the return you would have got in the last 3 years is fantastic. Look at the 3-year return in any mid-cap, small-cap, large-cap equity fund. So when markets are truly cheap, you should invest in equity and not in asset allocation fund at this point of time. But once markets move out of the truly cheap phase, you should invest in asset allocation is the framework that I tell my colleagues. And they accuse me of being too cautious. But I say that every year there'll be something which will come up, which becomes very cheap. Like 3 months back, when we told people, look at silver. In my dream, I didn't believe we'll get 28% return in silver in no time. But we got that return in no time, actually. And like there was a time when we told people invest in we had a scheme which invests in gold equities and oil equities. That scheme gave very quick returns. So, there are times when you should invest not in asset allocation, but in equity to get big returns. But that's not always. That way, asset allocation can be invested at all points of time. Whereas these things should be invested when they fall, become attractive, etc.
It doesn't, what the question was, doesn't this asset allocator or multi-asset funds automatically trigger that? So when the, commodity was cheap or equity was cheap, automatically they said Naren would have taken a very larger position.
They do. But asset allocator fund couldn't have invested in China. Asset allocator fund could not have invested in Taiwan. Asset allocator fund couldn't have invested 100% in silver. That's also there.
So ballpark, what could be a good signal to say for a client to see that, when he finds, what should be a ballpark level where he finds that the equities market, whether international or domestic are considered.
Whenever there's complete fear and people are running away.
Right.
In any asset class. That is a time to consider that asset class for lump sum.
Great. Thank you so much. I think it answers the questions which came to me as well.
So Naren, one question is in terms of with Make in India theme, which are sectors which looks favorable to you in terms of defense, auto, digital, or something else which looks good to you?
I don't know. I think it will play out, but it will play out over a long period of time. That's why textile, defense, auto ancillary, chemicals, even IT, in a way, IT services, business services, all these will play out, but they're not like, something which will play out overnight.
Okay, Naren, this other question is slightly strategic. They think globally passive funds also have done well. Well, in India, we have not seen much of passive funds doing very well. What's your take on them?
No, I think you will see the answers. No, go and look at 3-year returns on many of the active funds run by our company. I'm not saying that they will always do this well, but there are so many active funds in our company which have done so well. So that is the situation. And I believe that there is a place for active money in a country like India, even over the next 3 to 5 years. But when you measure people on a very short period of time, I don't think it is necessary for active to do well. They may do very badly compared to a passive. But over the long term, there are a lot of inefficiencies which exist that can play a role. And you're the best judge. You look at the data.
Sure. So Naren, this question is more in terms of, again, a strategic portion. So globally, we are 100 to 104 trillion economy, where China plus one was supposed to play a good role for us, which could not play in the same fashion for India in the first phase. What is the take there? How well we are positioned to take, especially in sectors like smartphone, medical equipment, and API and some other fields? What's your take there?
I think in mobile phone, I think in terms of assembly, we have got it right, but we are not making the semiconductors. So I think in many of the areas, what all we'll be able to do, we have to see. So that is how we see it.
Sure. Thanks. Bharat, the word back to you.
Great. Thank you, Naren. Thank you for your time. And I'm sure it was enlightful. We try to make it sharp. And thanks a lot for spending time and sharing your thoughts. Thank you.
Thank you. Thank you all. Thank you to all the customers of ICICI. Thank you. Thank you for organizing it. Thank you.
Thank you, sir.